welcome to the podcast, everybody. Thank you for joining me. Markets are closed. It is August 4th, and you can go to our website, eggerscapital.com, if you want more information, EGGERSScapital.com. Of course, our telephone number is 210-526-0057. Just a quick note, just to remind everybody, our radio show is now moved from 7 a.m. to 9 a.m., so you get a couple hours of extra sleep on Saturday mornings if you'd like to listen to the radio show. So thank you for that. Hey, so the stock market, people are making a huge deal that the stock market has rolled over. And, it's toast, it's rolling over, and we're destined to have another 40 to 50% drop. That could be the case. But for right now, we don't see any evidence just yet that is imminent. In fact, if you look at the S&P, I've kind of scroll out here. This uptrend we've been in, outside of the October sell-off, and we just had a little bit of a sell-off recently. We kind of bounced off the 200-day moving average twice. But for the most part, you kind of zoom in, we're still moving sideways. If anything, you could say we're kind of forming this little wedge, right, where it's kind of, making higher lows, but the tops are there. Bottom line is there's not a whole bunch to do just now. And now there are places to avoid. There's places to be. There's places that are starting to look interesting. But as far as the overall stock market, not a huge concern just yet. Now we are getting some, deterioration. We've talked about that for several weeks, that there's deterioration happening in the overall market. When you look at the number of stocks participating in the rallies, when you look at the number of, the commodities breaking down, there are some things, junk bonds, there's definitely some warning signs, but those are things that could turn around quickly. And so we need to be cautious that, this bull market becoming a bear market is more of a process than it's an event. And if it is the process of happening right now, there's going to be plenty of rallies along the way that you can get out with. Now, if you're worried about and you can't sleep at night, that means you probably have too much money in the stock market, period. So you really need to zoom out and look at your overall allocation. But the part that should be in stocks, obviously there's some maneuvering going around, but I'm still not at the point where saying, yes, we need to exit all positions at this point. And again, the market will tell us when that time is, but we aren't there yet. Now, there has been some deterioration, as we mentioned. If we take a look at one of the things that could be dragging the market, Apple. We wrote a blog article yesterday about Apple. Everybody made a big deal that it had fallen below its 200-day moving average, and you can see it right there. Yes, it has done that. And so, of course, there's more selling came in. Even today, the stock was down another 2 or 3% today. Bounced off its low, but was down 3%. Volume was pretty heavy, as you can see down here. And I think, and if you want to see the picture of it, I think this thing could fall down to this area right here. And the reason I'm saying that is, let me draw a picture for you. So this little line in the sand right here is kind of the first support. We could fall a little further, and we could go back weekly. I could show you that, but you can go to the site. We had a little breakout. We tested that, came back. Now we've broken back below. So this thing could bounce right off here. That would be the first logical support. Beneath that, you could end up at $95. Again, if you want to go look at a weekly picture online, you can do that. Look, this stock, the reason it's an important deal is because of the fact that it's in a lot of the indices. It accounted for 25 points of the Dow today. So the Dow's down 47. 25 points were simply Apple. It's also a member of the S&P. And the S&P, it's even worse because it's market cap weighted. Well, Apple has a $700 billion market cap. So when Apple falls, it affects the S&P. So all those indices are being affected by Apple. And Apple's kind of in this lull right now where people are saying, what's the next product? You working on a car? What are you doing? The watch has been kind of I don't want to say it's a flop. They don't give us numbers yet, but I think it's been a flop so far. I don't think you have near the buzz around this product that they thought there would be. I think wearables is a great concept. I think it's going to be a big part of our lives. But to me, it needs to get a little cheaper. It needs to be more user-friendly. And apparently it eats up the battery out of your phone. So, it's just not there yet, and the early adopters bought it, but it hasn't been a needle mover for Apple so far. But again, for me, this is a dividend stock. That's what this is. It's good quality, cheap stock, and yes, it can fall. It's had a nice run. It can fall. I'm not selling them on our dividend portfolio. That's where we own it, so it's not a trading vehicle. What we do with it, though, is sometimes we've sold it on the way up. If it got too cheap, we would add to it. So we kind of use it as a core position in there, and then just trade around it if you want to say it. That's what we do with it. But as far as trading it and saying, I think it's going to go to 100 and then I'm going to buy some and sell it back at 140, I just don't think this is the type of stock to do that with. A lot of people, still the most tweeted stock out there, but for me, it's not that type of company. There's other companies out there that do that. Now, if we take a look at oil, and this is the USO, we're at new lows on that. If we take a look at the oil itself, keep in mind that this is what you're about to look at is a day old, but we're probably gonna test that low there, which was around 42.5 or so. So we could test that, and it wouldn't surprise us at all. What we're looking for, though, is a divergence with the energy stock. So when you look at XLE, and we go back, this is the weekly picture, okay? And if I was to go back even further to like 2002, this is the uptrend line. And you can see we hit it in 09, we're hitting it again. So what we're looking for is, when do these stocks start reacting differently than the commodity? In other words, if the commodity keeps falling but the stocks stop falling, that would tell you it's over. But people are asking me, when is the time to invest in energy? And I would say it's now, is right now. However, having said that, these stocks are going to be really volatile. They're going to trade around. If you want to trade it, that's fine. I think long-term investments make sense right now from an investing standpoint. And again, where do you want to be on that food chain? Because the weaker companies, some of them may go out of business. But when I look at a company like, and this is a company we own in our Dividend Plus portfolio, Conoco. Conoco just raised their dividend. They've been asked, are you going to cut your dividend? Their dividend right now, their dividend yields almost 6%. They just raised it a penny. And, so what's happened is the CEO's being pressured. You're going to cut the dividend? He said, no, the dividend's safe, dividend's safe, dividend's safe. And, but this is a stock right now that is off its high by about 40% back in mid-14. And again, going back longer term, it's coming to the support level. So these are screaming buys in my book. I don't care what anybody says. I don't care what the next 2 months look like. I care what the next 6 months, a year, 2 years, and 5 years look like. And I think anytime these companies have fallen this much in this short amount of time, they're a good buy. They're in a good investment. Now, the refiners are doing much better in the short run. Some of the E&P companies, again, are having some serious trouble. But I think, buying a basket or buying some for the dividends are fine. And even if these companies cut their dividends, I would be okay with that. Again, go back in history and look, when these companies have had this type of drop, what happens over the next year, 2 years, 5 years, 10 years? You make a lot of money. So there could be a period where the stock market itself moves sideways and energy outperforms. There could be a period where emerging markets outperform the S&P. So just be careful that what's worked in the past year or two, can be turned on its head. Obviously, owning the S&P 500 has worked great, but that's because the Fed has kept rates so low. Now that they've ended QE and they're threatening to raise rates, are we going to see a shift into something else? So we'll see. But energy, to me, as an investment, is a buy right here. I think it's a buy. As a trade, we could get into that. I don't know if it's necessarily a trade just yet. If I was to let's just take a look at XLE, and certainly it's getting there. It's getting oversold, but it was oversold a week ago. It rallied a couple days, and now it's getting even oversolder, as I like to say. But yeah, this is going to bounce at some point. There's going to be a short covering rally, but it may not be the bottom. If you look at this thing, it could rally up to where it kind of broke down here a month or so ago, 12% or so, and then roll back over. But again, looking at the big picture here, were they overpriced here? Sure. Are they getting underpriced here? They're getting there. And so I like that whole sector. But again, you can't, have 30% of your portfolio in there. I mean, we're talking about small percentages that we own, so we can sleep at night and continue to hold those. Volatility index. Yesterday, the Dow Jones got hit pretty hard, and yet the volatility index was down on the day or flat. Today, up 3.5%, just not a big deal. So you're not getting the fear. Another way we can tell there's no fear right now is if you look at interest rates. Interest rates today were up on the day, and that means bonds sold off. So if you own treasuries, they sold off. Typically, you're going to see interest rates come down as fear is coming back in. So another way to view it is TLT, you see this is going up. That means there's been some fear lately, people buying treasuries, but today we didn't see that. Now, if we kind of zoom out, what's going on here with treasuries, by the way, since we're on it? Well, you saw it broke out of this downtrend. It's been in for a while. Still stuck underneath this 200-day moving average. It failed a couple of times. So if you're looking to trade interest rates, notice it failed there. And now we're here potentially failing again at the 200-day moving average. So what I would want to see is maybe a break above that, maybe a pullback to it, and then start to turn up. And that would be your trade right in here. So again, if you own treasuries, I don't fault you for owning treasuries. We own some in our income portfolio because it is a risk-off vehicle, right? When people are scared about something, they go flock to treasuries. So, and everybody would thought treasuries were the worst investment. They've actually been a pretty good investment the last couple of years. But since February, they have not been a good investment. And so, again, they may be traded, but they are a risk-off vehicle. So if you want some kind of safety that kind of moves opposite of stocks, this is probably your game. If we take a look at gold, nothing doing. I mean, I kind of feel like gold, as I do with commodities in general and oil, that, I think energy makes a lot of sense. Gold, I think it's getting oversold, and I think if somebody bought some today, that's fine. I do think ultimately this thing goes below $1,000 an ounce. But, I think it could bounce in the short term and then eventually fall beneath $1,000 an ounce. So, again, if you want to buy some right now and put it in the closet, for the next 10 years, will you make money? You probably will make money. I mean, again, anything that's sold off this much, this fast, tends to rally. And so here we are. But we could even get one of these situations where, remember, late in the fall of 14, winter of 15, we started to see, we saw gold rally 14, 15%. We saw it at the beginning of 14. We saw a 15% rally. I would suspect we'd get something like that could take us up to the top of this channel. So if you want to try to trade that, it's getting close. But if you're talking about investing in it, yeah, I guess it's a better investment now than it was, 2-3 years ago, because gold is down at over 40%, 45% from its high in 2011. And here we are. So be careful with these things that seem logical. I was talking to somebody the other night, and I said, if I would have told you in 2011 our debt was downgraded, we lost our AAA rating on our bonds, if you would have told me gold would have fallen 45% over the next 4 years and bonds would have rallied on that, treasuries, I wouldn't have believed you. And yet that's what's happened. So sometimes the obvious isn't the obvious. And same thing right now. You think the stock market's going to crash. The obvious isn't there. Maybe the stock market goes up another 50%. And there are pundits who actually today are calling for a 50% rise in the stock market over the next couple of years. And you say, well, how could that be? We've already had this run. Well, have we ever seen the Fed this accommodative in our lifetimes? No. And so is it quite possible that there is a one last burst? I mean, we've never seen a stock market, and I don't have a picture to show it to you, but we've never seen a stock market peak when everybody thought it was going to peak, and there was this much pessimism. I mean, most of our indicators are showing too much pessimism. That's when rallies typically start on this type of pessimism. Usually, rallies end on overconfidence. Well, I don't know about you, but when I talk to folks, they're not overconfident. They're looking around going, well, this doesn't look very good, does it? It looks like this thing's about to head on down. And so that's not typically how bull markets end. They end on euphoria. So we could get another burst up before this thing ends. And just be careful because, again, they talk about never shorting a dull market. Yeah, you could say the market isn't dull, but this sideways movement we've been in for all of this year is dull. And so we could burst on up. So just be careful about leaning too far in one direction or another, whether it's too heavy in stocks or too light in stocks. And so we've been a proponent of looking at alternative streams of income, alternative assets. We've been a proponent of owning some dividend stocks that continually raise their dividends, having some trades on for people that are aggressive, having some different positions to buy and sell. But it has not been an easy market this year by any means. But that doesn't mean that you run for the hills. You just bide your time. Markets don't always go up, and they don't always go down. So last thing I'll end with is the NASDAQ. And again, we could point out different things here. We could point out a head and shoulders top, shoulder right here, head, shoulder, and that we're heading down. Could be. But I will say technology has been one of the leaders through this. You still kind of got this uptrend in place. Nothing major going on. So again, don't don't get shaken out because of some bad press one day. There's things that are going to move, but just make sure you're trying to stay in the game and let your winners run. And and if there's something that you feel is undervalued, don't turn everything into a trade. I think that's the problem is many people want to turn everything into a trade. There are some investments out there that you're going to have to put up through thick and thin. One of the charts we like to show folks is let's take a look at Netflix. This is a great example of a stock that came public, and it's kind of hard to see on here, but this was a 70% drop. This, I think, was an 90% drop. You had a 40% drop in one day. We went through another 80% drop in 11 to the beginning of 12. And since that time, the stock's gone split adjusted from $7 to 121. Okay, now the only way to make this return, and by the way, this return since going public has been, about 9,400%. 41% a year if you held it. The problem is nobody held this stock because they got shaken out. So sometimes all it takes is one catalyst. What was the catalyst here? Well, remember what was happening during this fall. When Netflix was falling, what happened? Well, everybody can provide content now. There's Amazon Prime. There's Hulu Plus. I mean, Netflix is just another one of them. And they changed their pricing model. Nobody likes them anymore. What happened during this time? They came out with their original content. One little thing changed, and it was good content. Boom. There it goes. It's gone. So be careful because, if a stock's beaten up, there's one little catalyst that can change it. And the point of this is that this is not an easy ride. I mean, to ride something down 50, 70, and 90% is very difficult. So you better make sure that company's going to be in business. But if it is, and things are still going okay, this is what can happen after a 90% fall. I mean, since the summer of 12, so you're talking 3 years now, Netflix is up 1,500% during that time, 3 years. So not all stocks are going to do this, but the point is to endure that type of pain. The only way to get those types of gains is to endure the pain temporarily. So some investments pay off big time, and some things are for trading. And this has been a very choppy stock. It's gapped down. You can see here into 14, it fell 25%. And then at the beginning of 15, it jumped 25% in a day. It's been an amazing stock, but definitely has been a risky stock. And the only people that have made that kind of money are the ones that stuck with it. And frankly, I don't know too many people like that. Probably Reed Hastings, the CEO, has been one of the few. So anyways, just a little lesson there on investing versus trading. But keep shooting your questions to me, Karl, Karl, @eggerscapital.com. And we will talk to you soon.